Hey everyone, welcome back to Corporate Decoder, where we uncover the hidden stories in financial reports. And today we're diving into Neuberger Berman Advisors Management Trust's mid-year report, a peek into their investment strategies and how they're navigating the market landscape in 2025. Now, this isn't just a dry look at numbers, it's a decode of how big investment firms are playing the game. We'll break down their top investments, their sector focus, and what it all means for the money they manage. Think of it as translating corporate speak into what really matters for investors. So who are we looking at? Neuberger Management Trust is a player in the investment management scene, managing various portfolios. This report covers the 6 months leading up to June 30, 2020-2025, a crucial period to see how their chosen strategies are performing. Let's start with their mid-cap growth portfolio. For a hypothetical investment of $10,000, the costs for Class I shares were a modest $47, which is 0.90% of the investment. For Class S shares, it was $57 or 1.10%. This gives us a small insight into the expenses tied to different share classes. Now for some key figures. The fund's net assets stood at a substantial $589,346,081. They held 80 portfolio investments and their portfolio turnover rate suggests active trading, perhaps repositioning the portfolio more frequently to capture growth opportunities. Looking at their top 10 securities, the highest holding was Royal Caribbean Cruises Limited at 3.3%. Following that were Axon Enterprise Inc. at 2.8% and Cencora Inc. at 2.5%. Seeing companies like Royal Caribbean and Axon gives us a sense of the sectors they're betting on. Sector allocation is also telling. Information technology accounted for 21% of their total investments. Consumer discretionary was next at 20.5%, followed by industrials at 20%. This strong focus on tech, consumer, and industrial sectors highlights a growth-oriented strategy. Moving on to the mid-cap intrinsic value portfolio. The cost for a $10,000 investment here were $52 for Class I shares, or 1.06%, and $61 for Class S shares, or 1.25%. These figures are slightly higher than the mid-cap growth portfolio. This portfolio had net assets of $121,577,801. They held 71 portfolio holdings with a much lower portfolio turnover rate of just 7%. This suggests a more buy and hold strategy focusing on long-term value. In their top 10 holdings, Williams Coss Inc. was at 2.8%, followed by Centrepoint Energy Inc. at 2.7%. Aptiv plc and Gates Industrial Corp plc were tied at 2.5%. This portfolio seems to be invested in more established companies. Sector-wise, information technology led with 27%, industrials followed at 20.6%, and consumer discretionary at 9.8%. The sector breakdown here is quite different from the mid-cap growth portfolio, showing a different investment philosophy at play. Now let's look at the quality equity portfolio, formerly the sustainable equity portfolio. For Class I shares, the cost on a $10,000 investment was $44 or 0.87% annually. For Class S shares, it was $57 or 1.12%. This portfolio is their largest, with net assets reaching $873,985,112. It held 43 portfolio holdings with a remarkably low portfolio turnover rate of only 5%. This indicates a very long-term investment horizon. Top holdings here are dominated by tech giants. Microsoft Corp was the largest holding at 9.9%. Amazon.com Inc. followed closely at 9.8%, and Alphabet Inc. Class A at 7.3%. This concentration in mega cap tech stocks is a clear strategy. Sector allocation showed information technology at 29.3%. Financials came in second at 27%, and consumer discretionary at 14.2%. This heavily weighted IT and financials approach speaks to a focus on established large cap market leaders. Finally, we have the short duration bond portfolio. Class I shares had a cost of $47 or 0.94% for every $10,000 invested. This portfolio had net assets of $78,923,320. It held a much larger number of holdings, 368, with a portfolio turnover rate of 40%. In terms of top issuers, Federal Home Loan Mortgage Corp represented 5.5% of total investments. State Street Institutional U.S. Government Money Market Fund Premier Class was next at 4.6%. Federal National Mortgage Association was at 4.3%. This shows a significant exposure to government-backed mortgage securities. Their portfolio by investment type shows mortgage-backed securities at 30.7%. Corporate bonds made up a significant 38.9% and asset-backed securities 23.6%. This bond-heavy portfolio likely aims for stability and income generation rather than aggressive growth. Looking at the income and expenses for the mid-cap growth portfolio for the 6 months ending June 30, 2025, we see total income of $1,561,662. Total expenses were $2,915,028. After accounting for reimbursements, the net investment loss was $1,272,066. However, the story shifts when we look at realized and unrealized gains. The portfolio saw net realized gains on investments of $70,624,848 and a decrease in net unrealized appreciation of $14,843,780. This resulted in a net increase in net assets from operations of $54,509,002. So while they had an investment loss, they made significant gains on sales, which is a key differentiator. Let's check the financial highlights for Class I shares of the mid-cap growth portfolio. The net asset value per share started at $31.28 and ended at $34.46. Total return for the period was a strong 10.17%. The ratio of net expenses to average net assets was 0.90%, which is quite reasonable for an actively managed fund. For Class S shares, the net asset value began at $26.62 and finished at $29.29 there. Total return was 10.03% and the ratio of net expenses to average net assets was 1.10%, slightly higher, reflecting the Class S share structure. For the short duration bond portfolio class, iShares starting NAV was $9.66, ending at $9.96. The net investment income to average net assets was a healthy 3.89%. The portfolio turnover rate was 40%. This suggests they are actively managing the bond holdings, perhaps to take advantage of short-term interest rate movements. In our assessment, Neuberger Berman Advisors Management Trust demonstrates a clear difference in strategy across its portfolios. The mid-cap growth and quality equity portfolios are clearly focused on growth with significant holdings in technology and consumer discretionary sectors. The low turnover in the quality equity portfolio, for instance, highlights a strong conviction in those long-term holdings. The short duration bond portfolio, on the other hand, shows a more active management style likely aimed at capital preservation and income generation in a potentially fluctuating interest rate environment. What stands out is the significant gains they achieved primarily through active trading in some of their growth portfolios, which compensated for the net investment loss reported. The expense ratios are generally competitive, especially considering the active management involved. A key risk for the growth portfolios could be market volatility impacting those concentrated tech holdings. For the bond portfolio, on the other hand, shows a more active management style likely aimed at capital preservation and income generation in a potentially fluctuating interest rate environment through active trading in some of their growth portfolios, which compensated for the net. Now, what's your take on these investment strategies? Do you think their focus on tech and growth will continue to pay off, or are the bond holdings the safer bet? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more deep dives into financial filings. Also, join our Discord community linked in the description for even more insights and discussions. Thanks for watching, and I'll see you in the next video.